Hello everyone, you are here because we are learning how to equity account for private limited company. In this lesson, you will be able to calculate dividends, share capital, and retain earnings. You will also be able to prepare journal entries to record contribution from shareholders, dividend declaration, and transfer of profit or loss to the retained earnings account. You will also prepare some ledger accounts for share capital, dividends, and retained earnings. All right, so these are the main things that you will be doing in this lesson. Now, what is shareholders' equity? Now, shareholders' equity is a term which you see only in private limited company. In a sole proprietorship, you don't see shareholders' equity, you see owners' equity. So the term shareholder is quite unique to a private limited company. Now, what accounting theory does it is applicable to this? Same as the sole proprietorship, the accounting entity theory is applicable. Now, to understand why, please go back to your sole proprietorship notes. It is the same reason. The point of view is not from the owner, but rather from the perspective of the business. All right, the transactions of a private limited company is separate from that of its owners or its shareholders. So because there are some differences in terms of private limited company and sole proprietorship, the equity section of a sole proprietorship, you only see one thing, you only see capital. But the equity section of a limited company, you see more than that, all right? You see two things. You see capital and you see retained earnings. All right, so you might need to copy some stuff, and if you need to copy some stuff, you don't have enough time, you can pause the video. All right, so in the N levels, you only need to know how to account for a single owner, one owner. And really that's quite straightforward because it's presented as a single line item. You see as capital inside the financial statements. But in the O level, you need to learn how to account for a private limited company. You need to know how to do equity accounting when there are many owners, and you need to know that it's presented as two line items in the financial statements. You see as share capital and retained earnings. So shareholders equity for O level, private limited company, owner's equity for N level, sole proprietorship. Because the ownership structure of a private limited company is different from a sole proprietorship, there are also different things in the shareholders' equity. So the equity section of a private limited company consists of two items, all right? Basically, you will see share capital and retained earnings. All right, and not only that, retained earnings itself is made out of two different items. Retained earnings are made out of profit or losses minus away dividends. So retained earnings is made out of profit or losses minus away dividends. Okay, now there are a few new terms here. Shareholders' equity is a new term. Retained earnings is a new term. Dividends is a new term, right? So these are some new terms. So what we are going to do is that we are going to explain each of these new terms. The first one we start off with is share capital. Share capital is basically cash raised by issuing shares to shareholders. So basically your business needs money and you tell your shareholders, I need money. I'm going to sell you shares and you are going to give me cash, right? So the cash that you get from selling your share, that is your share capital. Now, share capital can be calculated by taking the total number of shares times the issued price per share. That is how we calculate share capital. Pause if you need a longer time to write. Now, the next term that I'm looking at is retained earnings. So what is retained earnings? Now, retained earnings is basically an accumulation of profit or loss. All the profit and all the losses that your business has earned or made over the past many years, all added up together. The total profit or losses. And this total profit or losses, they have not been distributed to the shareholders. Okay, so basically, you did not distribute them to your shareholders. You have been just accumulating them. Now, retained earnings are renamed as accumulated losses if the value becomes negative. Meaning what? You have not made profit since day one. You have only been making losses. Losses after losses after losses. And therefore, we will rename that as accumulated losses. Apart from that, what else do we need to learn how to define this profit or losses? I think profit or losses, we are quite familiar with it. Profit or loss just means the total profits earned for the total profit earned and the total losses incurred for a particular year. Now, the final term that we need to know is what dividends are. Now, dividends is a little bit like drawings for a sole proprietorship, right? So dividends, we don't call it drawings in a private limited company, we call them dividends. So dividends are the portion of the retained earnings which you are going to distribute to your shareholders. Means you're going to pay out these retained earnings to your shareholders. Now, the payment of these dividends depend on the number of shares. Okay, so the number of shares your business has. Okay, so if you have 100,000 shares, every share will get a portion of dividend. All right, so how do we calculate the total dividend? We calculate the total dividend by taking the total number of shares times the value of declared dividend per share. How much dividend is given per share? So for example, if the business says every share will get $1 dividend, and if you happen to hold on to 100 shares, you will get 100, which is the number of shares, times the declared dividend per share, which is $1 per share. So you'll get $100. Okay, that's how we calculate the total dividends. All right, now that we know all what all these items in the shareholders' equity of a private limited company is, let's think about what can cause their changes. So going back here again, just to recap, the equity section, the shareholders' equity section equals to the share capital, all right, plus retained earnings, which is made out of profit or losses minus dividends. So what can cause changes in shareholders' equity? Changes in shareholders' equity can be due to three things. It could be due because you are issuing new shares, or you have told all your shareholders, I'm going to declare some dividends. I'm going to pay you guys some dividends. Or it can be due to profit or loss for the year, whether you made a profit or a loss. Now, what you need to do is to try on your own whether these 5 activities, increase or decrease shareholders' equity. So you can pause and just do a quick try. Pause now and try whether these items increase or decrease shareholders' equity. Are you done with it? Okay, if you are done with it, let's go through whether or not these activities will increase or decrease shareholders' equity. So firstly, when your private limited company issues new shares, all right, you issue new shares, you sell new shares, what happened here is your shareholders' equity has gone up. All right, your shareholders' equity has gone up. And when your shareholders' equity goes up, your equity will also go up. Your shareholders' equity also increases. So, when private limited company issues new shares, shareholders' equity will increase. All right? Okay, let's take a look at the second one. When your business makes a profit, when you make a profit for the period, what happens then? So let's take a look here at the equation. When you make a profit, you earn a profit, profit goes up. When profit goes up, retained earnings also go up, more retained earnings. And therefore, when more retained earnings, equity also increases. All right, so I repeat that. When you make profit, profit goes up, retained earnings go up, equity also goes up. All right, so when your private limited company makes a profit for the period, shareholders' equity also increases. Now let's take a look at what happens when your private limited company declares dividend. Declare dividend means what? You tell all your shareholders, I am going to pay you a dividend. All right, so that's a declaration of dividend. So when you have declared a dividend, what happens to your shareholders' equity? Now, when you declare dividend, dividends go up, right? Dividends go up. You have more dividends. Agree? But you need to be very careful because there is a minus sign in front of this dividend. All right, there's a minus sign in front of the dividend. So the more dividends you have, the lesser retained earnings you have. Do you have a lesser? It goes down. All right, the lesser retained earnings you have lesser retained because the inverse relationship. All right, the lesser retained earnings you have. And when there is lesser retained earnings, equity also goes down. So, dividends and shareholders' equity is an inverse relationship. The more dividends you have, the lesser equity you have. Is inverse. All right, so when your business declares a dividend, your shareholders' equity will decrease. Let's take a look at loss for the period. What happens when there is a loss for a period? Losses for a period is right over here. Now, losses are negative, so they are negative. So when there is more loss, all right, when there is more loss, it's again a negative amount. Retained earnings go down. It's an inverse relationship, same as dividends. So more losses equals to lesser retained earnings equals to lesser equity. So when your private limited company incurs a loss for the period, shareholders' equity also go down, decrease. All right, so now you are more familiar with the terms of shareholders' equity for a private limited company. Let's move on into accounting for shareholders' equity. Now there are four main items here, three, share capital, retained earnings, and dividends. And we need to know what that accounting rule is so that we know whether to debit it or credit it. Now, shareholders' equity is similar, same but different, similar to capital in a sole proprietorship. All right, it's very similar to capital in a sole proprietorship. So, share capital, accounting rule is minus plus. It is a credit normal balance. It has a credit nature. Okay, so increases in share capital will result in a credit. What about retained earnings? Now for retained earnings, also similar to capital, it also has a credit nature. All right, it also has a credit nature, and increases in retained earnings will result in a credit. Last item is my dividends. Now, dividends is similar to drawings in a sole proprietorship. Okay, so very similar to drawings in a sole proprietorship, and therefore its accounting rule is plus minus. It is a debit nature account, which means when dividends increase, you debit them. Right? So now we know the accounting rules. We need to commit this to memory. What we're going to do next is we're going to look at journal entries for recording share capital. Okay, we look at journal entries for recording share capital. Now, what is share capital? Like just now I explained to you, if you need more money, you go to your shareholders and say, hey, I'm going to sell more shares. Can you give me your cash? All right, so basically the shareholders, who are the owners of the business, contribute their assets to you. So recording share capital is basically recording a contribution of assets from the owner. Actually very similar to capital contribution in a sole proprietorship, right? Very, very similar. And therefore, whenever you want to record share capital, these are the two accounts affected. You debit assets and you credit share capital. All right, and we're going to look at example 1. We're going to look at example 1 as an example in this case. Okay, so let's go and take a look at example 1. I think you need to flip a few pages. Let's flip to example 1. Here we go. Here is example 1. Wong sets up a travel agency, Align Tours Private Limited. It's a private limited, not a sole proprietorship, and it specializes in ecotourism. It has a financial year end on 31st of December. And what it has done is that on the 31st of January 2019, it has issued 100 ordinary shares at $1.20 each. Hey, then some students will ask, Miss Lee, what is these ordinary shares? Now, an ordinary share is a class, a type of share. There are different types of shares. There are ordinary shares. Sometimes there are preference shares. Sometimes there's class A, class B. And call ordinary shares are basically the basic entry-level shares. All right. So owners of basic entry-level shares will allows them to have a right to vote and during major decisions of the business. It also allows them to receive dividends. Other classes or other types of shares, which we don't need to study for POA in the O levels, you will study if you go university, are like unit preference shares. They may not be allowed to vote, but they can get dividends, for example. All right, so the first question is asking you to calculate the total share capital on 31st of January. So how do you calculate total share capital? Think for a while. Flip to the previous pages and say, total share capital equals to the total number of share times issued price per share. All right, so we go back again. So to calculate total share capital, I take 100 shares, total share capital. I take 100 shares times $1.20 per share equals to 120,000. Remember, no dollar sign, no mark. All right? So that is calculating. The command word is calculate. Do a simple calculation, show all workings. Next, prepare the journal entry to record the issued share capital. So what should I do? Firstly, every journal entry, the format is date, account, debit, dollar sign, credit, dollar sign. And then date, right? So we know here that 100 ordinary shares were issued on 31st January 2019. So we have January 2019. What is the first account affected? I will record share capital increases. I have more share capital, credit 120,000. Now, what is the other account affected? You receive cash, right? So you'll record cash at bank and you'll record that as a debit. What is the narration? The narration is a short summary of what this transaction is about. So the narration is to record issuance of shares for cash. That is my journal entry. If you need to pause, then you should pause. Okay, the next question, C. So my suggestion is for you to finish listening to this part of the video, then after that pause the video and write down what you see on the screen instead of pausing every few seconds. So what you are asked to do is to prepare the issued share capital account, or rather it's a share capital account. Account is another word for a ledger, right? So in a ledger, they want date, account or particulars, debit $, credit $, balance. They want you to prepare the ledger, tell them what has happened inside the share capital account for this year. Now, because it's a new business, there is no balance brought down. Instead, I will write my accounting rule first, minus plus, and then after that, I will record, oh, I actually issued share capital here on the 31st of January. So that's what I'm going to record. On the 31st of January, the share capital account has increased by 120,000. Why? The other account affected is cash at bank. I received cash at bank. If I read through the question, nothing else has happened this year. So all I need to do is to close the account, 2020 balance brought down. Now you can pause and copy. All right. If you are done with copying, I'm done with example 1, 2. You can try this question. You can try the workbook questions. Exercise 3, question 1. You can try workbook exercise 3, question 1. All right. And I am going to move on. So you can pause if you need to copy. Right. Next, I am going to be talking about journal entries to record the transfer of profit or loss to the retained earnings, closing of income summary. Now, this is very similar to your sole proprietorship. At the end of the year, you will have to close your income summary account and transfer it to the capital account. Same thing. Retained earnings is recorded at the end of the year. So end of year, you do these two things. You either close income summary or you must do these two things. You close income summary and you close your dividends. So how do you record it if you have a profit? Well, if you have a profit, then this is the double entry that you should record. All right, if you make a profit, your business earned money unexpectedly or expectedly, you should record debit income summary and credit retained earnings. At this point in time, I want to say this is that retained income summary has no plus minus or minus plus, so I should look at retained earnings. Now the accounting rule for retained earnings is minus plus, and when I make a profit, equity increases, and therefore when equity increases, I should be recording it as a credit. If retained earnings is a credit, then income summary should be the opposite. Why? Because every double entry, every journal entry has one credit account and one debit account. So income summary is a debit because retained earnings is a credit. This is what happens if a business makes a profit. What if it makes a loss? Right? What if it makes a loss? If it makes a loss, then this is what happens. Let me reduce the line spacing. All right, if it makes a loss, then this is what happens. If it makes a loss, then we should be recording debit income summary and if the business makes a loss, we record credit income summary and debit retained earnings. Okay, why? Because losses, losses, remember just now we did that question, losses will cause your retained earnings to go down. All right, and when retained earnings go down, right, accounting rule for retained earnings is minus plus. So when retained earnings go down and your equity is reduced, you should record it as a debit. And because every debit must have a credit, income summary is a credit. All right, so this is the double entry to record closing of income summary. Let's try example 2, which is really easy as well. Continuing from example 1, so a line 12 continues all 3 examples. They perform well during financial year ended 2019, and they make a profit of 30,000. What you need to do is to prepare the journal entry to transfer the profit to the retained earnings account. So what is the double entry to transfer the profit to the retained earnings account? So what's the date? You see the date, the year end is 31st December, right? And you transfer the profit at year end. You always transfer profit at year end. So the year end date is 2019, December 31st. Okay, so firstly, you can write down income summary. It's a profit, but if you cannot remember, right, how income summary, is it a debit or credit for profit? Don't worry, go and consider your retained earnings first. Retained earnings accounting rule is minus plus, and if it's a profit, retained earnings will increase. And so therefore, retained earnings will be a credit 30,000, sorry. And if retained earnings is a credit, then income summary is the opposite. It will be a debit. So your narration would be to transfer profit from income summary to retained earnings. And now you can pause if you need to copy this. What about the retained earnings account? So like what you did previously, don't copy first, maybe listen first. All right, so retained earnings account, accounting rule is minus plus. So I will always write that to help me to visualize better. All right, so this is a brand new business, so there is no balance brought down. But if it's an old business, there may be some retained earnings from previous year. All right, and therefore you may have a balance brought down. But because this is brand new, there is no balance brought down. All right, and you only have one transaction so far, which is retained earnings credit 30,000. And that's what we are going to record. Retained earnings credit 30,000. Where did it come from? It came from income summary. So under the account name, we will write income summary. Okay, now how do you close a retained earnings account? Retained earnings account are closed via balance brought down. But I just want to say first, don't close it yet because there are other transactions in example 2. There are some other transactions in example 2, so don't close it yet. So at this point in time, what have you learned how to do? You have learned how to record issued share capital. You also learn how to record or transfer profit or losses to the retained earnings account. Okay, hang in there. We are 2/3 way through, all right? So what we are going to do, the final thing that we are going to do, go back to that page again. Yes, we are going to record the journal entries for recording dividends. All right, you're going to do dividends now. Now, when are you going to record journal entries for dividends? You will record them as and when dividends are paid. Are declared. You will record them as and when dividends are declared. Meaning what? If your dividends are declared on 1st of April, April Fool's Day, then you will record it on April Fool's Day. If your dividends are declared on first day of the year, then you will record it on the first day of the year. If your dividends are declared on the 31st of December, then you will record it on the 31st of December. Whenever you declare dividends, you will record these journal entries. All right? Now, when you declare dividends, there are two possibilities. There's a possibility that you declare the dividends, you tell the whole world, I'm going to pay you dividends, but you have not paid them yet. That's the first possibility. The second possibility is you tell the whole world, I'm going to pay you dividends, and then you immediately pay them your dividends. All right, so there are two possibilities. We will do the first instance first, where you declare dividends and you have not paid the dividends. So if you declare the dividends and you haven't paid them, actually you owe your shareholders the dividends, all right? There's a liability. Because a dividend declared, right, it's like contractual obligation. You are obliged to pay the dividends. So once you tell people, I'm going to pay you, it is the entitlement. They become like a liability for you. So once you declare a dividends and you haven't paid it yet, you will record this. Debit dividends and credit dividend payable. All right. Debit dividends, when you increase dividends. Okay, you increase dividends and you increase a liability, you credit a liability, a dividend payable, which is a liability. So that is what happens when you declare your dividends and you have not paid them yet. Okay, so as usual, maybe you want to wait until the end of this section, then you pause and copy everything one shot. The next thing that might happen is that you are going to pay out the dividend later. All right, you pay the dividends later. After you declare, say you tell the whole world, I'm going to pay you dividends, and then after that you pay them, right? You have to pay it. So when you pay it, you will record a minus liability, or you debit your dividend payable, minus away your payable, and then you minus away your asset. You pay via cash at bank. So that's what happens when you pay your dividends later. So this is the first scenario. You declare dividends, you never pay them, and then after that you pay them. All right? The second scenario is that you immediately pay your dividends the moment you declare them. So you tell people, I'm going to pay you dividends, and then you pay them immediately. So this is the double entry. This is the double entry when you declare and pay dividends immediately. Firstly, you are going to record a debit dividend, increase in dividend. And then after that, you minus away your asset. You minus away asset. Okay, because you pay out already. So there are two possibilities. So what we're going to do here is that we are going to look, so this is when you declare the dividend, meaning as and when the dividends are declared, whenever you declare dividends. Might be in the beginning of the year, the middle of the year, or at the end of the year. Okay? Now, can you remember the formula that we had just now? We looked at just now? That really, the retained earnings is made up of profit or loss and dividends. Right? So this means that actually the dividends must go into your retained earnings. All right? Dividends must go into your retained earnings. Dividends will need to be transferred to your retained earnings. And when you transfer your dividends into the retained earnings, these are the double entry. Firstly, when do you do it? You do this at the end of the year. All right, you transfer all the dividends at the end of the year. And we say closing of dividends to the retained earnings. All right, so what do you do? Firstly, we are going to record at the end of every year, you are going to record a minus dividend and a minus retained earnings. All right, minus away, you take out from the retained earnings and put it, you take out from your dividends and put into retained earnings. All right, take out from your dividends. That's why you minus away dividend here. And then you put it into retained earnings. And when there's more, when you transfer the dividends into retained earnings go down. Why? Let's take a look at that sentence again, that formula again. Okay, here. So when dividends go down, when dividends go up like that, right? Because of this minus sign here. All right, because of this minus sign here, your retained earnings will go down. Sad life but true. So retained earnings will go down when you transfer dividends into your retained earning account each year. So let's take a look at example number 3 to illustrate what this means. So let's take a look at example number 3. Flip, flip, flip. Firstly, you are continuing from examples 1 and 2. So this is a continuation from example 1 on 2. On 31st of December 2019, Align Tours declared a dividend. So they declare a dividend means what? They tell the whole world, I will pay you a dividend. And each dividend will pay 8 cents per share. Meaning for every share, you are going to receive 8 cents of dividend. So if you have 1 share, you receive 8 cents. If you have 2 shares, you will receive 16 cents. Very sad. All right. Now, when will the dividends be paid? The dividends will be paid in 31st of January 2020. I just want to highlight to you that this is actually the next year. It's not the same financial year. It's actually 2020, the next year, in the next financial year. All right. So firstly, you want to calculate the total dividends that will be paid or declared by the business. And you do that by taking 100,000 shares times 80 cents dividend per share, and the total dividend is $8,000. Moving on, you are going to prepare the journal entries to record a few things. You're going to prepare the journal entries to record the declaration of dividends, transfer of dividend accounts to retained earning accounts, and the payment of dividends. So let's start with declaration. So this is when you tell everybody, I am going to pay you. Now, when do you record declaration of dividends? You record it on the date that you declare, whenever that date is. And according to the question, on the 31st of December, the business declared a dividend. So the date to record this is the 31st of December 2019. What is the double entry? I declare a dividend, so I record dividend increase, debit dividend. Have I paid it at 31st December? No, I will only pay 1 month later, next year. And therefore, since I have not paid it yet, I will record dividend payable, a liability, credit 8,000. What is the possible narration? A possible narration is to record dividends declared but not yet paid. Now, at the end of the year, you need to transfer this dividend. This dividend that I'm highlighting in turquoise here needs to be transferred to the retained earnings. So now you have debit dividend, $8,000, and we need to take it out of the dividend account and put it into the retained earnings account. So now we are going to transfer dividend to the retained earnings account. And when do we do it? We do it at the end of the year. So firstly, I'm going to take out the dividends, no longer debit but credit dividends. Why? Take out from here. Take out from dividend. So therefore, if I want to take out from dividend, it's a credit balance. What's the other account affected? Take out from dividends, credit dividend, and I debit retained earnings. I debit retained earnings. The summary or the summation, to transfer dividends to the retained earnings account. All right. Next one, payment of dividends. When you pay your dividends. Okay, so when you pay dividends, what are the two accounts affected? So when did you pay? From the question, you paid dividends on January 31st. So we record 2020 January 31st. And when you pay your dividends, you don't owe the dividend payable anymore. So you record a minus dividend payable because you don't owe this dividend payable anymore. Apart from that, you also record a credit cash at bank. Why credit cash at bank? Because it is you pay out. So credit cash at bank, you pay out from your bank account. The summation would be to record payment of dividends. Next, we are going to prepare some ledgers. The ledgers that we will prepare is the dividend payable account as well as the retained earnings account. All right, so dividend payable account. Firstly, what is the double entry for, the accounting rule for dividend payable? It's a liability. So the accounting rule is minus plus. I will write the accounting rule under the debit and credit columns. Secondly, I know that firstly, in the dividend payable account over here, right, I actually had this dividend payable, increase in dividend payable, which I'm going to highlight in green now. Increase in dividend payable of 8,000. So in my dividend payable account, there's going to be an increase of dividend payable, credit dividend payable, 8,000. What is the other account affected? The other account affected is dividend. So I write that in the account name. Actually, as at year end, I did not pay it. So if I didn't pay it, I need to bring the balance down. I need to bring the balance down. Oops, forgot to include this. I'm going to bring the balance down here. Okay, so I need to bring the balance down January 1st. Balance brought down, $8,000 credit. I need to bring the balance down. And then when do I pay the dividend? I paid it on 31st of Jan, and that's where I see 31st of Jan. My dividend payable account reduced, minus. Why minus? I pay already, so I don't have this payable anymore. The other account affected is cash at bank. At the end of the year, or rather at the end of the month, there's nothing left in this dividend payable account because I have paid it fully. Okay? Next, I will be looking at my retained earnings account. So maybe you want to not write first and listen, and then later you can write it out when you can pause the video. All right, retained earnings account. Now this is a brand new business, right? And you don't have any retained earnings apart from what you had recorded earlier on. So what you have recorded earlier on, maybe I'm just going to scroll backwards to show you what you have recorded here. There you go. It's the retained earnings account, right? And you recorded the profit, the transfer of the profit into the retained earnings account. And I told you not to close it yet because there are other transactions. So this is our starting point, okay? Looking at example 1 and example 2, your starting point is that there is already, you have already recorded, right? You have already recorded the income summary, the profit for the year. You transferred that in, right? And now what we're going to do is that we are going to transfer the dividend in. So let's take a look at the double entry. What am I doing? I'm actually recording this entry. I'm going to reduce my retained earnings because I have declared some dividends. Okay, so I am going to reduce my retained earnings. Retained earnings actually reduces, it debits, and it debits by $8,000 because I have declared some dividends. But there is still a balance at year end. All right, there's still a balance at year end. Therefore, I need to close this account by having a balance brought down on 1st of Jan 2020. All right, and so my balance brought down is 22,000 credit. Okay, so here is my retained earnings account. Excellent. So actually you have learned pretty much to do most of everything, and finally we are going to put all of this together in the statement of financial position. And I am just going to ask you to perhaps just copy it later when you can pause it. And another thing that I want to say is that this example actually requires you to look at example 1, example 2, and example 3. You must look at all of them, okay? So now we are finally prepared to prepare our statement of financial position. Now the statement of financial position is, the format is pretty much the same as the sole proprietor, no difference. All right, so you write the business name. Right, you write the business name followed by the title name, which is statement of financial position, and then you have three column, right? You have three columns, and you are only going to prepare the shareholders equity section as well as the current liability section, these two sections. So firstly, we name our shareholders equity section. What is in shareholders equity? Going up to the previous page on the formula. What is in shareholders equity? Share capital as well as retained earnings. So these two things form the shareholders equity. And we have shareholders equity, right? So we have share capital. Now we have to say the number of ordinary shares. So we just say share capital 100,000 ordinary shares. And then we write the value of the shares 1200,000. Actually, how to get this? It was the 100,000 times the $1.20, right? Yeah, so that was how we got this 120,000. Okay. Next, we are going to record the retained earnings. Retained earnings is actually only for 1 year. Very small retained earnings. Where do you get this number from? Can you remember this? Is that your retained earnings account? There was this $22,000 credit. That's where it's from. The balance of the retained earnings account is 22,000. So therefore, yikes. Therefore, the total shareholders equity, you add the two up together. Excuse me, I think it's over here. Okay, you add the two up together is 142,000. Of course, over here, you're going to draw a line. Okay, so that is the shareholders equity section. Now, what you need to do is to prepare the current liability section. So what is in the current liability? One thing and one thing only. I mean, for now lah, the dividend payable. So the dividend payable $8,000 is still unpaid as at year end. So that is under the current liabilities. You owe your shareholders $8,000. Okay? And that's it. With this, you are done. All right, with this, you actually have learned how to calculate dividends, share capital and retained earnings. You learned how to prepare journal entries to record contributions from shareholders, dividend declaration and payments. You also learn how to transfer profit or loss to the retained earning account. You also learn how to prepare ledger accounts for share capital, dividends, and retained earnings. All right, you actually also did this lah. You also able to identify reasons why shareholders equity change is because issue share capital change or profit or loss for the year, or dividends declared. Right? So you did learn how to do this now. So moving on, what should you do next? You should practice, and you can considering practicing these questions. Not consider, we did practice these questions in class, so you should practice them. Question 1, exercise 3, exercise 3. Question 1, question 2, question 3. We did these in class. Okay? See you in class. Bye-bye.